Be Wealthy and Smart, episode 1611.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about mortgage refinances jumping 40%. Yes, mortgage demand spiked markedly higher last week as consumers returned from the holidays to find overall lower interest rates and then a sharp rate drop Friday on news from the White House, according to CNBC. On a social media tweet by the president saying he would order mortgage giants Fannie Mae and Freddie Mac to buy $200 billion in mortgage-backed bonds, the average rate on the 30-year fixed sunk briefly below 6% on Friday before bouncing back slightly higher again, according to Mortgage News Daily. Total mortgage application volume jumped 28.5% last week from the previous week, which was adjusted for the holiday, according to the Mortgage Bankers Association's seasonally adjusted index. And for the whole week, on the MBA survey, the average contract interest rate for the 30-year fixed-rate mortgages with conforming loan balances of $832,750 or less decreased to 6.18% from 6.25%, with points falling to 0.56 from 0.57, including the origination fee for loans with a 20% down payment. Joel Kahn, an MBA economist, said rates started to come down a little just before that, and part of it might be a bounce back from the holidays, even though we did adjust for the holiday and the results the week before. It's always a noisy time. This is a real move based upon the rate drop. Spreads have been moving in even before the announcement. And refinance demand, which is most sensitive to daily rate changes, surged 40% higher for the week and was 128% higher than the same week a year ago. Kahn said the average loan size for refinance applications was also higher, as borrowers with larger loan sizes are typically more sensitive to changes in rates. Applications for a mortgage to purchase a home, which are less sensitive to sudden rate changes, rose 16% for the week and were 13% higher than the same week a year ago. The increase there was probably driven more just by people returning from the holidays, easing home prices and more inventory available for sale. Mortgage rates moved higher to start this week, according to Mortgage News Daily. They bounced Monday on the expectation of higher oil prices and then a little higher Tuesday. Matthew Graham, COO of Mortgage News Daily, said things might have ended up worse today had it not been for a reasonably well-received CPI report. That's Consumer Price Index. This important data showed inflation remaining in check in December, with the most widely watched metrics coming in just below the median forecast. And we see wholesale prices moved up less than expected while consumers kept up a heavy buying pace in November, according to economic data released Wednesday, in which the Producer Price Index, a measure of final demand prices and producers get in the marketplace, rose just 0.2% for the month, according to seasonally adjusted figures from the Bureau of Labor Statistics. That was below the Dow Jones consensus for a 0.3% gain, though 0.1 of a percentage point higher than October. The headline Producer Price Index was up 3% from a year ago, ahead of the Federal Reserve's 2% target. On the consumer side, retail sales rose 0.6% for November, according to Commerce Department figures adjusted for seasonality but not inflation. The November gains were broad-based, with motor vehicle and parts dealers, building material and garden centers, gas stations, sporting goods stores, and miscellaneous outlets all seeing gains over 1%. So wholesale inflation was softer than expected, and retail sales moved higher in November, along with massive mortgage refinancing. Shows you how sensitive the markets are to interest rates. According to the CME FedWatch tool, there are strong expectations for the Federal Reserve to hold rates steady at the January 28th meeting, but there's a 94% chance of moving to a 3.25 to 3.5 range by March, with the market forecast suggesting 1 to 2 cuts in 2026. I'm projecting one cut in the first quarter of 2026, so we'll continue to monitor the situation and report back to you as it unfolds. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.